Now, Bradley, what he did was he developed a model based on the different planetary cycles, and the planetary cycles are the number of days between Venus and Mercury and the number of days between Mars and Jupiter, and all these cycles have summations, and they have places where they meet together called conjunctions or oppositions or sextiles. They're nothing more than numbers. There's absolutely nothing mysterious about this. It's just a numbers-related game. And Bradley was able to put a graph out, and I've been putting this graph out forever. Well, not forever, for me it is, but we started studying this phenomenon from 1876, and we keep it up to the present day. He has a better than 70% chance of predicting what the market's going to do over the next year, and you can do this graph 2 and 3 and 400 years ahead of time, or 5 years ahead of time. It's not going to change. For some reason, these cycles are there, and they do work. They're not perfect, but they give you a better idea of just about anything that you can find, and realize that you can do it ahead of time. The real change that's happened here, the past 2 or 3 weeks, the Royal Bank of Scotland, that's the second largest bank in the world, came out with a special report about buying on a full moon, buying on a new moon and selling on a full moon. It was 20 times better than a buy and hold recommendation. If you folks would like to have that article, if you'll contact Shelley Simon, and I think Matthew has her number and email stuff, because you're going to get a couple of weeks of the newsletter, you'll see the article itself, and it's really quite startling. Now, when a big bank like this comes out with some research, it doesn't mean a whole lot, but when academia gets it, when somebody like MIT or Harvard or Yale or Princeton or Oxford gets it, and they do the work, then all of a sudden you're going to see that on CNBC and on Bloomberg and other things, you're going to see whole segments on the astroharmonics. I happen to be scheduled to do CNBC Asia on August the 23rd for a 15-minute segment talking about astrology in Singapore. So that's going to be interesting. I'm going to go through a few of these Bradley models just to show you what they look like, and you'll see that they're not perfect by any stretch of the imagination, but they do a very good time of picking highs and lows and into trends. That's the thing that it does its best. And some of them are really quite spectacular. These are just the last 5 years of the market, but there's one particular one that I wanted to show you, and that is this one. This is the bottom of 2009. As you can see, the market came down very hard to 6,400 in the Dow Jones, and it basically, from the high to the low, for that whole 5-month period, it was perfect, and it was also perfect on the way up. It's been incredibly accurate over the thing, and we're showing a major top at this particular time. Whether it works or not, we'll just have to wait and see. But this is what the Bradley model is all about, and how I do cycle work. I did my original cycle work with the Foundation for the Study of Cycles. It was in Pittsburgh with Edwin Dewey and Gertrude Shirk back in the early 60s and early 70s. And then I didn't get involved in the astrology until the 1985-86 level, when my college, one of the college professors, Dr. Ruth Miller, showed me the relationship between the Fibonacci ratios and these planets. And that's what I'm trying to do here, is to show you that this relationship is quite pronounced, and it's very tradable. That's what the real beauty of it is. It's quite tradable, and that's what I hope to to give you. I can't do everything in just a couple hours. It takes 3 hours to be a professional trader, and unfortunately, the third hour today I won't be here. So we'll go on to the next one. And this is the most important slide. Well, actually, the most important slide is that picture of Pythagoras, but this is probably the second most slide that I have here that is of importance. This is from an article in Business Week on April the 17th, 2000. Dr. Andrew Lowe from MIT, who is a chair in applied mathematics, he is the one who supplies the brains to the Wall Street people, the big quants. He came out and he wrote a paper on technical analysis and said that technical analysis was really an incredible way to predict what things were going to be in the future. What Dr. Lowe did was he looked at 800,000 patterns from 1962 to 1996. These are the typical ones that technicians look at: double tops, double bottoms, head and shoulders, three peaks, triangles, patterns, pennants, and things like that. And he became so popular with this that he wrote a book shortly thereafter called The Non-Random Walk Down Wall Street, which he basically said that the markets are chaotic in nature, but within the chaos are non-random patterns that repeat over and over again with the predictability and reliability that no other methodology can employ. And that was, he was talking about fundamental analysis. But it is an incredible book. It's 754 pages, but unless you're a rocket science, I don't think you'll understand it, because the formulas that they use are just really, you know, just way out of sight to prove the reliability of these things. Now, I've been doing this myself for many, many years, and I've proven to myself that these patterns work, but, you know, I'm just an old cowboy from Tucson, Arizona, so nobody's going to listen to what I have to say. You have to be from MIT or Harvard or Yale or Princeton or something of that nature, and then, you know, you get the time necessary for people to listen to what you have to say. Now, this is from Dr. Lowe's book. This is also known as the chaos game. It's the Serpinsky Triangle. Basically, Serpinsky was a Polish mathematician, and he developed this game that magicians use quite a bit. But basically what it's saying is if you take a dot and draw a line on this dot and then just keep extending the line in any particular way, after it's gone through 10,000 repetitions, it's going to look like this. What's important for us as traders is that what we're really looking for. We're looking for a high to a low to a high. That's what we're trying to do when we're looking for a pattern. One other thing, this is the picture of a perfect pyramid. The one in Giza is 754 by, I think, 457. You divide the height by the width, it comes out to 0.618. But more important than that, all three of the pyramids of Giza set on the celestial equator. And the celestial equator is what you see if you're 50 miles up looking down at the Earth. It splits the Earth at the exact meridian, north, west, east, and south, at that exact spot. And that's why it's amazing, because, you know, who was up there 10 miles telling him to build it right there? That is a question that I'll leave for the next time I come through this way, which will hopefully not be for a few more years. Okay, now this particular geometric characteristics of a price chart are important, because basically when we have a price chart, it is nothing more than a square that has within it two triangles, and it also has a pyramid and a circle, and eventually you get to the point where you have all of them coming together, and that leads to the far right is basically what we're doing when we're looking at pattern recognition. We know that we have certain triangles that are in a pattern where we go from high to low to high and low to high to low, and what we're trying to do is to predict what these patterns are doing, whether it's a pennant or whether it is a flag or a double top, double bottom, head and shoulders, whatever it happens to do. Now, fortunately, because we have these numbers of the Fibonacci summation series, we're able to get really close to where we think we're going to be. But remember, trading is all about probability. It's never about certainty. You must focus on how much you have to risk at any one time, and that's the most important thing that you can do when you are trading, is to focus on the risk. Now, this is an expansion of the previous chart. This comes from a very rare book called from Thrust and Recoils by William Garrett. It's called The Thrust Method, and basically what he's looking at is where you take a square to a circle to an ellipse, and then take another one, square to a circle to ellipse. Now, our planetary system that we deal with, our galaxy, is elliptical in nature, and this is exactly what NASA uses when they send a rocket probe up. Once they get the probe into the orbit of Mars and they want to send the probe to Jupiter, all they have to do is to fire the rockets, and the it'll take it into the orbit of Jupiter, and then it'll go, and then if they want it to land on Jupiter, they can fire the rockets, and then the probe will go down and land on the land on the planet. Now, this is really nice, but all we're trying to do is to find out what the Euro is going to do Monday morning. So our job is a heck of a lot easier. But this is how cycles work. They expand by 618, 1.618, 2.618 in pi. This is why people that look at cycles like 16 and 32 and 64 cycles, those cycles are static. And believe me, the cycles in the markets are dynamic. They're either expanding and contracting, just like that very first picture of the spiral mirabilis, where everything is either expanding and contracting in the universe. So as we get ready to learn to trade, we have to decide, what the pattern is, how we're going to determine what the trend is going to be, and this is, the process of pattern recognition and learning how to trade. Now, what I'm going to do, and I'm going to give you a couple examples of how these planetary cycles are actually working. This is a transit chart showing where all the planets are lined up at any particular time. These particular things, these squares, trines, and conjunctions and oppositions, are nothing more than planets coming together. And each one of these transits pattern charts gives a certain probability with it. This happens to be August the 9th, 1982. This was the biggest recession we'd had since 1974. I don't know if you remember this, but the Dow was trading it had gone from 1974 to 500 to 1,000, and it stayed there, and then it started the big sell-off when Reagan was elected in 1980. In 1982, he made the comment, we're going to let the bulls loose sometime in April. Well, the cycles didn't come due until August the 9th, 1982. This was a huge cyclical event when you have all of these lined up like this, and you see these triangles. It's a big thing. And we have one of those happening. We have 5 of those happening for the month of August. 2 of them have already occurred. We have one coming up on the 11th, which is Wednesday, and then the big daddy of them all comes up on the 26th and 25th and 26th of August. That's going to be an event that I believe will make history. I don't know if it'll make history in the market or not, but it's going to be a historical event based on the way planets are set up, and these work pretty good. Now, this is what the charts look like in 1982. The S&P was trading at about 100, and if you'll see the insert, this is basically a blow-up of this particular area. You can see the market had made 3 drives. This is one of the patterns that we're going to look at a little bit later, but this is what was occurring. It happened on the exact date that was expected. That was August the 9th, 1982. It was actually started by Henry Kaufman. Henry Kaufman was at Salomon Brothers, and he was very, very popular person on CNBC. Wasn't even in business then, but he was on, I believe, one of the channels. It might have been CNN, and Louis Rukeyser, somebody like that. But he said that he thought that the stock market was bottoming because interest rates were, finally getting ready to go lower. And interest rates at this time are around 12, 13, 14%. I mean, T-bill rates were 11%. Tax-free munis were 14%. And this was the bottom of the recession, and that took us from 100 in the S&P, where it finally topped out somewhere around 1,600 back in 2007 in October. All I'm trying to do here is to match up the patterns, with the cycles that we're talking about, because the astroharmonic stuff is nothing more than a whole group of cycles coming together, and all you're doing is trying to match it what you're looking.